Are you feeling the pressure of rising prices in your daily life? Are you worried about the future of your finances? Don't fret, we're here to help. Inflation is a common economic phenomenon that can affect the purchasing power of our money over time. It's defined as a sustained increase in the general price of goods and services in an economy. In simple terms, it means that the same amount of money can buy fewer goods and services as time goes by. For example, an item that costs $100 today would cost $135 in 10 years, given a 3% inflation rate. In 15 years, the same item would cost $156, or over 50% more than how much it is today. The problem with inflation is that it can be unpredictable and can vary greatly from year to year. This makes it difficult to plan for the future, as we don't know exactly how much the price of goods and services will increase. In some years, inflation may be relatively low, while in others, it may be significantly higher. This unpredictability makes it difficult for us to budget and plan for the future. Despite the uncertainty and unpredictability of inflation, there are still steps you can take to protect yourself from its negative impacts. In this video, we'll be exploring a range of practical and effective strategies to help you survive inflation in 2023 and beyond. Number 1. Diversifying your investment portfolio. This means investing in a mix of different assets, including stocks, bonds, and real estate. By diversifying your investments, you can reduce your overall risk and ensure that you are not overly exposed to any one particular market. As a result, you can be rest assured that your investments are better protected and more likely to perform well over the long term. Investing in stocks can provide the potential for long-term growth and higher returns, while bonds offer a more stable investment option with predictable returns. Real estate, on the other hand, can offer a hedge against inflation as property values tend to rise along with inflation. It's also important to consider the impact of inflation on your investment portfolio. For example, if you have investments that are tied to a fixed interest rate, such as bonds, inflation can erode the value of your returns over time. On the other hand, investments that are tied to the performance of the stock market may offer more protection against inflation. Alternatively, you may want to consider adding alternative investments to the mix. Commodities and precious metals, for example, have been proven to hold their value over time, even during periods of economic turmoil and high inflation. These types of investments can provide a hedge against market volatility and serve as a safe haven for your money. Take a proactive approach to investing to ensure that your portfolio is well positioned to weather inflation and other economic challenges. This way, you'll be able to protect your financial future and reach your long-term goals despite the ups and downs of the economy. Number 2. Reduce your expenses. This can be done by finding ways to cut back on unnecessary spending, such as reducing entertainment expenses or finding cheaper alternatives for everyday goods. By reducing your expenses, you can stretch your budget further and ensure that you have more disposable income to put towards your financial goals. One way to reduce your expenses is to take a close look at your spending habits and identify areas where you can cut back. For example, if you're spending a significant amount of money dining out or entertainment, you may want to reduce these costs by cooking at home or finding more budget-friendly forms of entertainment. Another way to reduce your expenses is to take advantage of sales and discounts. Whether it's shopping for groceries, household goods, or personal items, you can often find great deals by shopping around and taking advantage of special offers. Additionally, you can look for coupons and promo codes online to help you save even more money. Not forgetting that it's important to be mindful of your expenses and avoid overspending. This means sticking to a budget, tracking your spending, and avoiding impulse purchases. By doing so, you can help ensure that you're living within your means and prepared for the impact of inflation. Number 3. Having an emergency fund. This fund is a set of money that you set aside each month so that you have a cushion in case of unexpected expenses or job loss. It serves as a safety net and helps ensure that you are able to weather any financial storms that may come your way. To start building an emergency fund, you need to first determine how much money you'll need to cover your living expenses for at least 3 to 6 months. This should include your housing, food, transportation, and other essential expenses. Once you have an idea of how much you'll need, you can start setting aside a portion of your monthly income until you reach your goal. It's important to keep your emergency fund in a liquid, low-risk investment, such as a savings account or money market fund. This way, you'll have quick and easy access to your funds if you need them, and you won't have to worry about losing your savings if the stock market takes a downturn. Aside from these strategies, it's important to educate yourself on economic trends and indicators of inflation, such as the Consumer Price Index, or CPI, and the Producer Price Index, PPI. Monitoring these indices can give you a better idea of the direction that inflation is heading in and can help you make informed decisions about your finances. Thanks for watching, and be sure to like and share this video with your friends and family who may find it useful. Leave a comment below and let us know what you think about the inflation and what you're doing to combat it.